Welcome to the Revenue Accounting Matters Step-by-Step course. Module 3, Determine the Transaction Price, is the third course in a series of 6. By the end of this course, you will be able to distinguish between a contract that contains an option for additional purchases and a contract that includes variable consideration, demonstrate the differences between the estimation approaches for variable consideration and apply the constraint on variable consideration, and assess a payment or rebate to a customer, which may be subject to the guidance on both variable consideration and consideration payable to a customer. As you have learned, there are 5 steps in the comprehensive framework which defines how much revenue is to be recognized and when. This course will focus on Step 3, Determine the Transaction Price. In Step 3 of the 606 framework, an entity determines the transaction price associated with a contract. This requires consideration of both fixed and variable consideration, financing components, non-cash consideration, and consideration payable to a customer. The most challenging aspects of Step 3 generally relate to accounting for variable consideration. Variable consideration can arise for a wide range of reasons, including discounts, rebates, refunds, credits, price concessions, incentives, performance bonuses, penalties, or other similar items. In addition, variable quantities may also result in variable consideration, even if the rate per item is fixed. Some contracts include variable quantities, which may be in the form of an option for the customer to purchase additional goods or services. Implementation questions have arisen about how to distinguish between a contract that contains an option for additional purchases, which may or may not constitute a material right, and a contract that includes variable consideration based on a variable quantity, such as a usage-based fee. If a contractual provision represents variable consideration, it must be accounted for on day 1, whereas a provision that represents a customer option only requires accounting on day 1 if it constitutes a material right. Let's work through an example to identify variable consideration, customer options, or material rights. Click on Company X to work through the example. Review the facts about Company X. When working with Company X, additional facts come into play when deciding whether or not a contractual provision represents variable consideration. Review the details for each fact pattern. Consider whether each fact pattern described represents a customer option or variable consideration, and how should it be accounted for.
In fact pattern A, what is important here is that Company X produces within the contractual range almost all the time, or 95% of the time. The question is, does this contractual provision equal a variable consideration or customer option? The correct answer is A, variable consideration. Take a moment to pause and read through the correct answer. Now read through fact pattern B. The difference here is that Company X has protocols for when they produce outside of the range within the contract. For this fact pattern, the same question is being asked. Is this variable consideration or a customer option? In this fact pattern, it is a customer option. Please read through the answer now. A follow-up question to this fact pattern is, does this customer option constitute a material right? The answer is B, no, because the additional units would be bought at the standalone price. A final question before we move on. Which of the following is not a form of variable consideration? A discount, a rebate, a milestone payment, a customer option, or a performance bonus? The correct answer is D, customer option. These are not forms of variable consideration.
Variable consideration and the constraint on variable consideration are new concepts introduced by ASC 606. Some entities may find the new guidance on variable consideration, especially the estimation approaches, somewhat confusing. Let's review a straightforward example that demonstrates the difference between the estimation approaches. Click on Olive Company to review the facts.
Please pause the video here if needed and review the fact pattern. In this fact pattern, what's important is that the products can be returned for a $0 revenue, or they could be kept for a $100 revenue. Olive Company assumes that 97% of those products will not be returned. You can see in the journal entry on the screen that while they've received $10,000 worth of cash, they put up a refund liability of $300 for that uncertainty. A similar entry is done on the cost side. After reviewing that fact pattern, What is the method that they are utilizing for estimating variable consideration? Based on this fact pattern, the correct answer is B, the expected value method.
In some situations, various aspects of the revenue guidance must be considered in conjunction with each other in order to evaluate a fact pattern. One place this commonly occurs is when assessing a payment or rebate to a customer, which may be subject to the guidance on both variable consideration and consideration payable to a customer. The guidance on changes in transaction price might be applicable as well. Let's work through an example. Click on the Purple Company to review the facts. Review the facts about Purple Company and how those facts are used to determine when the effect of a coupon should be accounted for. Depending on Purple's facts and circumstances, the answer may vary. Click on each calendar date to review the scenario and see what should be considered.
As of December 28th, it will depend on whether it is customary for you to provide discounts such as the one being provided. If it is customary, you may need to recognize as of December 28th. January 2nd is the decision date. At this time, it may be appropriate to recognize. Please read through the full considerations on the screen. March 30th represents the communication date. If not previously recognized, the company would now recognize that reduction to revenue. A final question for this section. In determining the transaction price, an entity must consider all of the following except. The correct answer is C, estimating standalone selling price. This is not utilized.
Variable consideration is a significant shift in accounting guidance under ASC 606. Prior revenue guidance did not allow revenue recognition until the contract price was fixed or determinable. This change reflects the new standards principle that revenue should more closely depict the transfer of control, even if that means more uncertainty in the measurement of revenue. In some cases, the new guidance will result in recognition of revenue at an earlier date than under prior GAAP. Because of the increased uncertainty in measurement, entities will have to apply one of the estimation approaches required by the standard, and it is not a free choice. Each type of variable consideration must be measured using the method that will best predict the outcome. Further, estimates have to be updated each period, which may require new processes or system changes, particularly for long-term contracts. Variable consideration is one of the more subjective areas of the new revenue standard, in some cases requiring significant judgment. That is why a complete understanding of the guidance and an effective process to apply the guidance are so important. Now that you have worked through some examples of determining the transaction price, you should be able to distinguish between a contract that contains an option for additional purchases and a contract that includes variable consideration, demonstrate the differences between the estimation approaches for variable consideration and apply the constraint on variable consideration, and assess a payment or rebate to a customer, which may be subject to the guidance on both variable consideration and consideration payable to a customer.
So let's wrap up there. Comment with any additional questions you may have, and we can expand and help. Please subscribe so you don't miss any new content. Hey, before we continue, let me quickly tell you about a collaboration we are doing with the TB4A Shopify account that can save you some money and help support the channel in the process. Are you an accountant with a sense of humor, but are having trouble expressing that in the third meeting this week about account reconciliations? Maybe you're struggling to find that gift for your accountant friend or their new kid. Or maybe you're struggling to find some not-so-average office gifts. If so, check out TB4A's Shopify and get all the great business comedy gear. They're uploading new items each week. Use my code ACCOUNTINGACADEMY, all one word, for 10% off your purchase. Each sale will indirectly support this channel. Imagine bringing this fun cup to your next pointless meeting, so check out the link and see what you can find. Now back to the video. Alright folks, thanks so much for watching. Please like, share, comment, and subscribe. And if you can, donate at Patreon. Anything you can give helps to keep the lights on and ensures we can continue to create content. And of course, helps feed FIFO. If you want to contact us about anything you saw in this video, accounting advice, or ideas for future videos, contact us at patreon.com/accountingacademy.
This video is designed to be illustrative and does not represent an official position. We make no representations, warranties, or guarantees and assume no responsibility for the application of this material. Please seek advice from a competent professional if expert assistance is required.